commodities enjoying gains. We're seeing the dollar coming under pressure. But it's really a combination of inventories coming under pressure as well, and strong demand and very little supply coming to the fore. Let's start off with sugar. It hit a 30-year high on the 11th of November at 33 cents 39, and we're not very far away from that level. We're still sitting at 30 cents a pound. So we could see some more positivity coming through, and of course that means good news for the producers as well.
I think, as you correctly point out, there are a lot of supply and demand issues in the system. Sugar for this year, the forecast there is about 9.4 million tons in terms of a deficit. So if we remain in that sort of territory, you can expect upward pressure on the prices to remain. Brazil has actually had to up its production levels from the previously planned 24 million tons up to an expected 29 million tons by the end of this year, to try and plug some of that gap, because Indian production has fallen off quite dramatically, down some 46%, at least by the numbers they showed us to the end of November.
What about Brazilian exports next year? It seems that they are going to be ramping up exports. Could that then perhaps stabilize the sugar price?
Again, 9.4 million tons is a very large gap to sort of plug. If we go back to the previous season, we're looking at about 11.7 million tons. So the gap is closing, albeit slowly. And again, this is on the premise that all the other producers across the world are actually coming up with their projected numbers for this to actually remain in place.
What about the European Union's floor price on sugar? Because it seems that that is becoming redundant and people are looking elsewhere.
I think the biggest thing there is, for many years, the EU floor price has actually been much higher than spot, or what producers could actually get on other markets. Now you're getting a situation where that spot price and even the forward price is actually rising, coming up to the levels that the EU is actually selling, and in some cases surpassing what they actually give their quota producers. So I think the quota producers are now looking at that and thinking, well, we could actually be earning more money elsewhere. Maybe it's time we actually stop doing that. But bearing in mind, however, that the quota system comes to an end quite shortly.
The pricing regime on the African continent does differ quite extensively. What does it mean for the likes of sugar producers, Mumias in Kenya, Consumer in Morocco, Hippo in Zimbabwe? What are the growth prospects for these companies?
If we look at Mumias, I mean, they're in a very comfortable position, about 40% market share in terms of production. They're actually expanding their capacity, trying to come up with even more raw cane which they can process. And they're also branching out or diversifying into ethanol production, sort of ahead or in line with the changes that are coming through in Kenyan legislation. So I think the motivation for them to continue producing and selling their product locally remains high. Remember that they sell almost all their product locally, and they don't actually sell any of that out of the country. If we look at Consumer in Morocco, they source roughly 400,000 of the 1.3 million tons of raw sugar that they need from local beet producers, and government actually steps in to give a subsidy there. So that subsidy is obviously going to be affected by the rise that we're seeing on world markets as far as spot sugar and forward sugar is actually concerned.
Touching on the cotton prices, it's rallied 18% last week. It's been up around 73% so far this year. We're sitting at around $1.30 a pound, in fact. So we have been seeing price increases coming through there as well. And it's also supply constraints. It seems that China is not going to be embarking on as many crops this year because the cost inputs, and of course, it's very expensive from a labor perspective as well. But that means more opportunity for Africa.
Agreed. We've seen a supply squeeze. The Chinese producers have not been coming to the table, citing erratic costs as far as inputs are concerned, notably fertilizers and labor. So they have not actually been bringing forward more supply. You get places like central Queensland in Australia, where heavy flooding has also constricted the amount of crop they're actually putting out onto the market. So this all bodes well for the price, and we have seen it actually move quite aggressively in the year to date. Of course, in recent times, we have seen that pull back, largely because of Chinese regulations or reforms that have actually come through to try and slow down inflation and slow down demand in their home economy. So that has had impact on the price. Coming closer to home, however, you'll find South Africa is actually turning out its smallest crop in the last 60 years. So it's a bit of an unfortunate time there for that crop to actually be hitting bottom in terms of volume output. But we remain constructive on cotton prices going forward, and it's obviously something local producers
Would you
are
go
excited
for the
about.
Zimbabwean listed cotton producer as an investment opportunity?
ICO is a very interesting business. I think the issue there is the fact that they sell a fair amount of the product forward. So in the current situation where we are now, they're not getting full benefit. But obviously, as we go into future seasons, they will be able to take part in that. And side marketing remains an issue. But remember, from an economic point of view, we like cotton. The valuation might be a separate issue.
Cocoa prices rallying as well. We're starting to see a few political issues coming through from Cote d'Ivoire, which of course is the world's largest producer of cocoa. Levels we haven't seen in 3 months. Are these levels sustainable?
I think largely not. The biggest thing there is a logistical squeeze. We've had some disruptions to production and delivery coming through from the curfew that has arisen from the election crisis that they're experiencing in the country. If you look at production statistics over a longer period, however, we're looking at possibly 100,000 more tons coming through this year worldwide than were initially anticipated. So I think the price increases that we're seeing are rather temporary and related to what is actually happening within the largest producer, but this is not likely to sustain itself going forward.
Also touching on the overall picture when it comes to sugar, cocoa and cotton, what kind of exposure would you advise investors out there to have on their portfolio? We're looking at very volatile commodities, they're soft commodities. We're seeing shrinking stockpiles, as I said, loose monetary policy and weaker dollar, which is all going to prompt a lot of buying into these commodities and perhaps artificially inflate these prices. So as an investment opportunity, which of the 3 commodities would you add onto your portfolio?
As RMB Asset Management, we would obviously look for a business that has exposure to a commodity with rising prices. Sugar is looking attractive, and to some extent as is cotton. But however, the business itself ideally would have lower levels of gearing and very good cash flow generation. I think this would be what would guide our sort of selections in that regard.